What we have been doing so far is to record cash transactions using the general journals and posting them into the general ledger. This is part of the recording process in the entire accounting process. In this video, we'll be looking at how we report for cash transactions, where we'll be preparing the cash flow statement. To prepare the cash flow statement, we need to see the information that's available to us that tells us the cash receipts and cash payments for the period. We may be given a statement of receipts and payments, which is essentially a type of report that details the cash receipts and payments during a period, as well as the change in bank balance. Note that you are not required to prepare this report as part of the unit, but it's helpful to know if you are able to interpret the report and use the information given to prepare the cash flow statement. Here we are given a list of cash receipts as well as cash payments. And we're also told that we've got a cash deficit of $4,220, a negative amount that's written in brackets. This means that our total cash payments were more than cash receipts, and this will decrease the bank balance. We are given the opening bank balance, which is a positive amount of $13,500, and here we have a closing balance of $9,280. So clearly we can see that there was a decrease here because of the cash deficit. If we are given the statement of receipts and payments, we simply need to classify all the cash receipts and cash payments according to the three classifications that we will look into detail when we prepare the cash flow statement. Another way that we may be given the information for us to prepare the cash flow statements is if we are given the bank ledger account. So based on the knowledge of the ledger account, we know that our cash receipts are recorded on the debit side, whereas our cash payments from the bank account are recorded on the credit side. For the purposes of preparing the cash flow statement in this video, I will be referring to the bank ledger account, as I think that this is more complex compared to extracting the information from the statement of receipts and payments. Starting from the debit side, we can see that there are two transactions here that have attracted GST, and they are the cash sales. Now these GST amounts are GST received, which has been received as part of the cash sales. Now here's a quick reminder for you. When the business makes a cash sale to a customer, it charges the customer the sales amount plus the GST. Therefore, when the business receives the payment from the customers, it is actually for the total amount, including the sales and the GST. Therefore, it's important for us to remember that these amounts here recorded in the ledger account are the total amounts that we have received from the customers, which are both for the sales and the GST. Once we understand that, we now can calculate the total sales amount including GST, and this works out to be $47,300. Then, we calculate the GST amount by taking $47,300 divided by 11, and this gives us a GST amount of $4,300. Then, this allows us to calculate the sales amount excluding GST, and it works out to be $43,000. Moving on to the credit side, we can find here more transactions that have attracted GST. These amounts are GST paid on cash payments. It could be a cash purchase or a cash payment of expense. Now here's another quick reminder for you. When we are making payments to the supplier, perhaps for purchase of inventory, we make payments for the total amount, which includes the purchase amount of the inventory plus GST. Therefore, it is important for us to remember that the amounts recorded here on the credit side of the bank ledger account are the amounts including GST. Now let's break this down. Here are the amounts paid including GST. We have paid for electricity, totaling to $550 including GST. We have purchased shelving for $11,000 including GST. We have made two purchases of inventory, totaling to $22,000 including GST. We have paid for insurance, totaling to $1,320 including GST. And we've also made a purchase of office equipment for $4,950 including GST. Therefore, the total amount including GST was $39,820. Now we calculate the GST paid amount by taking the $39,820 divided by 11, and this gives us a GST paid amount of $3,620. Lastly, we need to work out the amounts excluding GST because this is important for our reporting. Let's start with electricity. $550 was the amount including GST. To calculate the amount excluding GST, we divide this by 1.1, and this gives us an electricity expense amount of $500. We do the same for shelving, inventory, insurance, and office equipment. We also need to look for any GST refunds or GST settlement to the ATO. Here on the 4th of December, we can see that there was a payment of $1,500 allocated against the GST clearing account. As this is a cash payment, we know that this is a GST settlement. It is a payment made to the ATO for a GST liability. Notice that it is not attached to any purchase or expense in the credit side of the ledger account. Think, what about a GST refund from the ATO? Is it a cash receipt or cash payment? Will it be recorded in the debit or credit side of the bank ledger account? Because a GST refund is a cash receipt, it would therefore be recorded on the debit side of the bank ledger account. The best way to prepare the cash flow statement is to work from the bottom up. We start with the financing activities, where only 4 items are reported here: capital contributions, drawings, loan from bank, and principal loan repayment. Then, we classify the items in the investing activities section. Only items related to non-current assets are reported here. It could be a purchase of non-current asset or a sale of non-current asset. All other items are reported under operating activities. Things like cash sales, GST received, GST refund, GST paid, GST settlement, receipts from accounts receivable, payments to accounts payable, wages, and interest expense. Basically, any items that are not reported under financing or investing activities are reported here under operating activities. The first thing that I want you to note is that interest expense is reported under operating activities, even though it's related to a loan. On the other hand, the principal loan repayment is reported under financing activities. The other thing that I would like you to note is that GST paid on any purchases or expenses, including purchases of non-current assets, must always be reported as cash outflows under operations. Going back to the ledger account for the bank, we will now look for transactions that relate to financing activities. Remember, we are only looking for 4 items here. Let us start with the debit side of the bank ledger account, which records all the cash receipts for the period. When we are preparing the cash flow statement, we always start by reporting all the cash receipts before the cash payments. On the 2nd of December, we have received $25,000 for a loan taken from Ost Bank. We report this under financing activities as a loan from bank, $25,000. On the 5th of December, we have a capital contribution of $5,000, which is a financing activity. Because there are no other transactions relating to financing activities under the debit side of the bank ledger account, we now move on to the credit side of the bank ledger account, which shows us all the cash payments from the bank. On the 21st of December, we have drawings of $6,700. This is a financing activity. But because this is a cash payment, we write the amount $6,700 with brackets. We have here another transaction on the 23rd of December where there was a repayment for a loan amount to Ost Bank. This is also a financing activity, And here I have reported it under financing activities as a principal loan repayment of $2,000 written in brackets. Now, a very important alert here for you is to note that only principal loan repayments are reported under financing activities. You should not be recording any interest expense payments here. Now on to the investing activities. Here we are looking for items only related to non-current assets. It could be a cash purchase or a cash sale. In the bank ledger account, on the 7th of December, we have purchased shelving for the total amount of $11,000. So remember from our earlier discussion, this amount includes GST. But when we are preparing the cash flow statement, we need to report the purchase of the non-current asset using the amount excluding GST. So let's take our purchase of shelving as an example. In the investing activities section of the cash flow statement, we report the purchase of shelving using the amount excluding GST, which is $10,000. Because this is a cash payment or a cash outflow, we therefore write this amount using brackets. We do the same thing for the purchase of office equipment on the 26th of December for the total amount of $4,950. In the cash flow statement, we report the purchase of office equipment using its amount excluding GST, which works out to be a cash payment of $4,500. And because this is a cash outflow, we therefore report this amount using brackets. Okay, so this is the last classification, which is the operating activities. And in here, we report all the other items that were not reported in financing and investing. Here in our ledger account, you can see that I've ticked off all the items that were already reported under financing and investing. Now let's start by looking at the cash receipts that are recorded on the debit side of the bank ledger account. On the 12th and 24th of December, we have cash sales that we report in the cash flow statement with a total amount of $43,000 excluding GST. The reason why we exclude GST from here is because we separately report GST received on cash sales in the cash flow statement, and the amount works out to be $4,300. Next, on the 20th and 29th of December, we have receipts from accounts receivable totaling to $41,500. Now let us have a look at the cash payments recorded under the credit side. On the 3rd of December, we have payment for electricity totaling to $550, including GST. Now when we report this payment for electricity in the cash flow statement, we use the amount of $500, which excludes GST. And the reason why we're excluding GST from here is because we'll be separately reporting the total GST paid amounts in the cash flow statement, as we will see shortly. On the 10th and 23rd of December, we have payments to accounts payable totaling to $41,400. Then on the 12th and 30th of December, we have purchases of inventory totaling to $20,000, again excluding GST. On the 15th and 29th of December, we have payments for wages totaling to $31,000. On the 19th of December, we have payment for insurance for the amount of $1,200 excluding GST. Next, we have payment for interest expense on the 23rd of December for the amount of $600. Now, here we report the total GST paid amounts on all cash purchases and cash expenses paid for. And it works out to be a total of $3,620. Lastly, on the 4th of December, we can see here that there is a cash payment that has been allocated to the GST clearing account. This is none other than a GST settlement, which is a payment to the ATO for GST owing. And the amount of $1,500 is reported as a cash outflow under operating activities. For each category, we'll calculate the total cash receipts, total cash payments, and the net cash flow. Let's have a look at the cash flows from operating activities. Here we have cash receipts from cash sales, GST received, and receipts from accounts receivable. We add this up to give us a total cash receipt of $88,800. Then we calculate the total cash payments, which are from payments to accounts payable, inventory purchases, wages, electricity, GST settlement, insurance, interest expense, and GST paid. And the total that we got is $99,820. The next thing that we need to do is to calculate the net cash flows from operations. And to do this, we take the total cash receipts minus the total cash payments to give us a net cash flow from operations. Here we can see that we have a net cash flow that's a negative amount, which means that we had more cash payments than cash receipts. Now we do the same thing for the other two categories, investing and financing activities. In our previous step, we would have calculated the subtotals from each category. So we now have the net cash flows from operations, net cash flows from investing activities, and net cash flows from financing activities. Now, if we take note of the net cash flows from operations, it is a negative amount written in brackets. This means that here we have a cash deficit where there were more cash payments than cash receipts. In other words, this will decrease the bank balance. The same thing occurred for investing activities where we have a cash deficit of $14,500. However, for our financing activities, we have a positive number, which is a cash surplus of $21,300. This means that we had more cash receipts than cash payments from financing activities, and this cash surplus will increase the bank balance. The next step is for us to add all these net amounts up to give us the net increase or decrease in cash position. So firstly, we take the net cash flows from operations, and the easiest way to do this calculation without making a careless mistake is to use negatives in the calculator for cash deficits. So we start off with a negative $11,020, and again negative $14,500, and positive $21,300. When you hit enter, you will get a negative amount of $4,220. In other words, this is a cash deficit that will give us a net decrease in cash position. We now know that we have a net decrease in cash position by $4,220. This cash deficit will decrease the bank balance. So in other words, whatever bank balance that we had at the start will now be decreased and we'll end up with a lower bank balance at the end. What we need to do now is to take the net cash deficit and add it to the opening bank balance at the start of the period. And where can we get this information from? It will be given to us in the question, and in this case, we can get the opening balance from the bank ledger account. Now we add up these amounts using the same approach as advised earlier, where we use negatives for the cash deficit amounts. In this case, it will be negative $4,220 plus a positive bank balance at the start, which was $13,500. So this gives us a closing balance of $9,280. To check our understanding, we can see how the cash deficit has lowered our bank balance from $13,500 to $9,280. Another thing to take note here is that we now have a positive bank balance of $9,280, which means that it is a current asset to the business. In our cash flow statements, you will notice that our opening bank balance is taken from the bank ledger account. Our closing bank balance in the cash flow statement should be able to match up to our closing balance in the bank ledger account if we have reported all the amounts and calculated the totals correctly. Here are some helpful tips for you to remember.